Welcome to Alternative Investment. Today, we're going to slice into the super exclusive world of high-end art. The big question is, can a regular investor, someone like you or me, actually get a piece of a masterpiece?
For, well, centuries, the art market has basically been this exclusive club, right? Super high price for admission. You're picturing those multi-million-dollar paintings, the glamorous auctions. It was a world that was pretty much completely sealed off from the everyday investor.
But, a new model has popped up, and it's promising to swing those gallery doors wide open for everyone. It's called fractional art investing. And the idea? It's actually super simple. Instead of needing, say, $1 million to buy a whole painting, you can just buy a small share of it. You get to own a piece and hopefully make some money as it goes up in value.
Okay, so let's get into it. What's the real appeal here? Why would you want to own just a tiny sliver of a Picasso? Let's take a look at why investors are so excited to add this, vibrant new color to their portfolios.
Well, the people who are really into this point to some pretty compelling advantages. First up, you've got diversification. The idea is that art prices don't always move with the stock market, which could help protect your portfolio, right? Then there's professional guidance. You get teams of experts making all the tough calls for you. And of course, the big ones, lower minimums, and just how accessible it is. You can literally buy a share of a masterpiece right from your phone. It's kind of wild.
And this is what really gets people's attention. The potential for some seriously impressive returns. So check this out. A report from Citi's global art market found that contemporary art has actually beaten the S&P 500 over the last 26 years. We're talking a 13.8% annual return, compared to the S&P's 10.2%. Now that is a number that's going to make any investor sit up and take notice, for sure.
Okay, but like with any beautiful painting, you really have to get up close to see the cracks. The promise is definitely alluring, no doubt about it, but the reality, well, it can be a whole lot more complex.
Yeah, that dream of high returns? It comes with a pretty real list of downsides. For one, the art market can be just incredibly volatile. The platforms? They often charge these high fees that just eat away at your profits. Plus, you have absolutely zero control over when a piece gets sold. And here's the kicker, a serious lack of liquidity. We're talking about having your money tied up for like 3 to 10 years. This is definitely not something you can just cash out of on a whim.
And when economists really crunch the numbers on this, a pretty clear picture starts to form. As one study put it, just because you're taking on more risk with art, it doesn't automatically mean you're going to get a bigger reward than you would with regular old stocks. A lot of the time, the math just doesn't add up.
And that's because, well, art just isn't like a share of stock. It's a totally unique and, let's be honest, often unpredictable asset. Every single piece is different. The market itself is notoriously opaque. It's not transparent like the stock market. And an artwork's price? It's often just a social construct, right? It's based on things like how famous the artist is or how much buzz is around them. And that's all before you even start thinking about the real-world costs like insurance and shipping, which can seriously chip away at the value.
So how does this whole promise versus peril thing actually play out in the real world? Well, it really all boils down to the platforms themselves. Because trust me, the one you choose makes all the difference.
So on one side of the coin, you've got the big pioneer in the space, Masterworks. And listen, they've built a really significant and legitimate operation. We're talking over 1 million users, more than $1 billion invested. And what's super important here is that all of their offerings are qualified with the SEC. That gives you a layer of regulatory oversight, which is huge.
But then, on the other hand, you have the cautionary tale of a platform like Yieldstreet. Now, they offer all sorts of alternative assets, art included, but the company has been hit with multiple investor lawsuits. And these aren't small claims. They're alleging really serious stuff, like misrepresentation, bad due diligence, and even fraud.
And when you read what some investors have shared, it paints a pretty grim picture. Look at this quote from a user review. They're alleging a totally catastrophic outcome. 6 out of 6 investments went into default. That really highlights what seems to be a recurring complaint about the platform's whole vetting process.
The level of risk that's being alleged in these legal filings is just staggering. One lawsuit, a fraud lawsuit, claimed the company's portfolio had a default rate 5 times higher than junk bonds. And just to put that in perspective for you, junk bonds are already considered some of the riskiest investments you can make. So 5 times that? Wow.
So if you look at all the investor complaints together, you start to see a pattern of these alleged issues. We're talking claims of shoddy due diligence, really poor communication, especially when a deal goes south, misrepresenting the risks involved, and in some cases, people losing their entire initial investment. It's no surprise that all this has led to the platform facing multiple class action lawsuits from its own users.
Okay, so what's the takeaway here for you, the potential investor? Well, the huge contrast between these platforms proves one thing beyond a shadow of a doubt. If you're even thinking about stepping into this world, you absolutely have to do it with your eyes wide open.
To even begin to navigate this market, you have got to be your own best advocate. So 1, do your own market research. 2, really check out the platform's authenticity process. 3, set a firm budget and stick to it, remembering this is a risky game. 4, be prepared to play the long game here. And finally, and this is probably the most important one, pick your platform wisely. You've got to dig into their track record, their fee structure, and most importantly, what other real users are saying about them.
And all this brings us to the final, crucial question you really need to ask yourself. Look, the idea of owning a piece of a masterpiece is incredibly powerful. I get it. But you have to be totally clear-eyed about what you're really buying. Are you actually getting a smart diversification tool for your portfolio, or are you just buying a slice of a very, very high-risk, unpredictable asset? And the answer, as we've seen today, really comes down to the homework you do before you put a single dollar in.